Welcome to The Explainer. If you're a focused investor who is completely serious about taking control of your financial future, you are in the exact right place. Today, we're unpacking a highly structured, incredibly efficient approach to the markets based on our source material, the four-pillar ETF strategy for lifetime wealth building. We're throwing out the daily market noise, and we're definitely skipping the financial media hype. Instead, we're looking at bold professional concepts to build long-term stability. Okay, let's dive into this. Let me ask you a question right out of the gate. When you look at your investment accounts, do you feel totally confident, or do you feel, a baseline level of anxiety? Is your wealth truly working hard enough for you, or are you constantly stressing out over picking individual stocks, trying to find that next hidden gem, or attempting to perfectly time the market is absolutely exhausting? And frankly, it rarely works out in the long run. Today, we are swapping out that stock-picking anxiety for a simple, low-stress, long-term wealth-building solution that actually makes sense.
Here's our blueprint for today. First, why invest in ETFs? Second, the four core ETFs. Third, portfolios by life stage. And finally, rules for building wealth.
Starting off with part 1, why invest in ETFs? The end of stock-picking stress. So the crucial point here is to think of an exchange-traded fund, or ETF, as a highly efficient investment vehicle. Instead of putting all your cash into one or two companies and holding your breath through every single earnings call, an ETF provides massive, broad diversification immediately. With incredibly low fees and super easy management, it literally allows you to own hundreds or even thousands of companies all at once. It completely eliminates the need to gamble on individual stocks, and it perfectly adapts to your age and risk tolerance as you progress through your career. Moving right along to Section 2, the four core ETFs, the absolute essential tools for your lifetime portfolio. Let's look at tool number 1, VTI, the Vanguard Total Stock Market ETF. This right here is the cornerstone of a long-term portfolio. It tracks virtually the entire U.S. stock market. We're talking about holding over 3,000 companies, spanning large cap, mid cap, and small cap stocks. It features an extremely low expense ratio, and it's highly tax efficient. By holding VTI, you instantly capture the massive market-moving growth of giants like Apple and Nvidia, right alongside thousands of smaller, hungry U.S. companies innovating in the background. Because it's so broadly diversified across the entire domestic market, it sits solidly at a medium risk level. Now, what's really interesting about tool number 2, VXUS, or the Vanguard Total International Stock ETF, is that it solves a massive blind spot for most investors: home country bias. Concentrating your wealth entirely in the U.S. economy is a huge, totally unnecessary risk. VXUS steps in and invests in more than 8,000 stocks outside the United States. It encompasses both developed markets like Europe and Japan, as well as rapidly growing emerging markets. With its low expense ratio, it actively offsets potential U.S. market weakness, adding vital global diversification at a medium to high risk level. Next up is tool number 3. BND, the Vanguard Total Bond Market ETF. Let's slow down for just a second, because this is where your portfolio finds its maturity and its balance. BND invests in thousands of U.S. government and corporate bonds. Instead of those wild, stress-inducing market swings, it provides steady, reliable income through regular interest payments. Historically, bonds are far less volatile than stocks. Think of BND as your financial shock absorber. It cushions your portfolio during market downturns and recessions. This is our lowest risk pillar, purely focused on capital preservation and stability when equity markets get turbulent. And finally, tool number 4, QQQ, the Invesco QQQ Trust. This is your high-octane growth engine tracking the NASDAQ 100 index. It holds approximately 100 of the largest non-financial companies, giving you heavy, concentrated exposure to technology and innovation. We are talking about the true modern giants here: Microsoft, Amazon, Alphabet. Because of this concentration in tech, it has historically delivered absolutely massive, strong growth. But listen closely, you have to be prepared for higher volatility. It is the very definition of high risk, high reward. And this brilliantly illustrates how our 4 tools complement each other to form a complete, impenetrable strategy. You've got VTI handling your core U.S. equity at a medium risk. VXUS adds global diversification at a medium to high risk. BND brings that crucial stability and income at a very low risk, and QQQ serves as your growth and innovation engine at a high risk. When you see the whole strategy laid out at once, you realize just how perfectly balanced this toolkit really is. Let's move to Section 3 and see how this builds. Portfolios by life stage. It's time to build your custom blueprint. Where do you fit in? If you're an aggressive investor, generally somewhere between the ages of 20 and 35, your blueprint targets maximum long-term growth. Because you have literally decades to recover from any market volatility, your objective is strictly to maximize returns. You'll notice a massive 75% allocation strictly focused on US and tech growth. That's 50% in VTI for broad US stocks and a hefty 25% in QQQ for that aggressive tech push. You keep 20% in VXUS for international exposure and just a tiny 5% sliver in BND for a bare minimum of stability. You're playing the long game here, for sure. Now, for the moderate investor aged 35 to 55, your strategy shifts. You're in your peak earning years, so you really need to balance growth with stability. The most striking change you'll see is that the stability slice, our BND bond allocation, grows significantly to 25%, and this is entirely by design. It protects your accumulated wealth during these crucial mid-career years while still maintaining a strong 45% in VTI and 20% in VXUS to keep your money growing. Your high-risk QQQ slice safely drops down to 10%. It perfectly balances growth potential with serious downside protection. For the conservative investor aged 55 and up, preserving your capital completely takes priority over aggressive growth. If you're nearing or actively in retirement, generating steady, moderate income is the absolute primary goal. Notice the dramatic flip where BND now dominates at a massive 50%. VTI drops down to 30%, VXUS to 15%, and QQQ is just a 5% sliver. This setup gives you a tiny touch of innovation exposure to keep pace with inflation without risking your hard-earned nest egg. Bringing us to Section 4. Rules for building wealth. Let's map out your path forward. The overarching narrative of this entire strategy is that your portfolio absolutely must evolve as you age. You can't just set it and forget it for 40 years. Step 1. Younger investors must emphasize VTI and QQQ to capture maximum long-term growth when they have the time to ride out the waves. Step 2. Middle-aged investors need to seek a balanced medium risk approach between stocks and bonds to protect their peak earnings. And step 3, older investors must emphasize BND, focusing heavily on capital preservation and reliable income. It's a highly logical progression from start to finish. I want to share this incredibly powerful summary from our source material today. While no portfolio is guaranteed to generate profits, maintaining a diversified ETF strategy, keeping costs low, and investing consistently over many years has historically been one of the most reliable paths to building wealth. It's not about trying to predict the future or outsmart Wall Street. It's about consistency, low fees, and extreme diversification. That is the true professional blueprint for success. So here's my final challenge to you. Look at your current portfolio today. I mean, really open up your accounts and take a hard look at them. Does that mix of assets truly reflect your current life stage and your financial goals? Or is it kind of just a random, chaotic collection of stressful stock picks you've accumulated over the years? Take this 4-pillar blueprint we unpacked in today's explainer, compare it against your own assets, and ask yourself if it's finally time to let go of the anxiety and start building structured, lifelong wealth. Thanks for learning with me today, and I'll catch you on the next explainer.